Technical indicators. I'm sure you have heard of some of them. Things like the moving average, the MACD, RSI, Bollinger Band. There's just so many of them, right? I mean, wow, look at what a colorful chart we have right here. What are technical indicators and what purpose do they serve? Some traders, especially the new ones, maybe when we look at the chart, we don't really understand what we're looking at. So one application of technical indicators is that it can kind of give us a way that we can interpret and understand the chart data. But how useful are they really? And should we be trading solely based on what technical indicators tell us? So in this video, I'm going to talk about three ways that we should not be using technical indicators. The first way is to not use technical indicators to try to predict the future. Now here's the thing. Obviously, when we invest, we're doing it with an opinion and a view of how prices can go in the future. And therefore, we are taking positions that we can benefit from such potential moves. So some people use the technical indicators that they put on the chart to try to predict these future price movements. The problem is this. The technical indicators are based on the historical prices. They're derived from the price that has already happened in the past. What that means is that technical indicators are actually lagging behind the price. How can something that tells us what has happened in the past be used solely as an instrument to tell us what's going to happen in the future? It's just like if we were to read a history textbook and just solely based on what is in that book, we try to predict what's going to happen tomorrow, next week, next month, or even next year. It just doesn't work that way. But as I mentioned earlier, the essence of investing is we are trying to predict what's going to happen in the future in order to take a position today to benefit from that move. So what then should we be using to predict the future? If technical data is lagging behind the market price, then we should be asking ourselves, what leads the market price? What drives stock prices? And the answer to that is demand and supply. So now the question becomes, why would the market be buying or selling the shares of this particular company? This requires us to become very familiar with the company itself and the environment in which it operates in. We have to look at things like economic factors, the company's financial strength, its business model, as well as what are the events that are happening in the world that could affect the demand and supply for this company's product and services, and therefore its profitability and growth. When we buy shares in a company, essentially we are owning a piece of that company. It's essentially as though we are going into that particular line of business ourselves. Now let's say you want to open a pizza restaurant. Now you're not going to just open the restaurant, right? You have to do some research first. You have to study the market. You have to study the surrounding areas. Is there a demand for pizza in this area? Are there like a lot of other pizza shops already in this area? What are some of these factors and considerations, right, that you have to think about that could affect whether your business succeeds or fails? And if you're going to be investing your life savings, your hard-earned money into this pizza business, or if you're going to borrow money from friends and family, or you're going to go to a bank to go into debt, these are the kind of things that you want to know before you go into that particular business. So it's the same thing here with investing. You have to do your homework before you go into that line of business, before you buy the shares of that particular company. And that means that we don't buy or sell based on what one line on a chart tells us. We don't use technical indicators solely to predict the future. The second way we should not be using technical indicators. We should not be using them as triggers to execute our trades. Let me give you an example. Now, one of the most popular and commonly talked about indicators is the Relative Strength Index, or the RSI. What does the RSI do? Basically, it measures the momentum or the strength of a recent price change, a recent price movement. Now, conventionally, what we are told is that there are two levels of the RSI, whereby if the RSI is above 70, then the stock is considered to be overbought. And if the RSI falls below 30, then the stock is considered to be oversold. So maybe you have heard about these trading systems that are built on these conventional wisdoms, whereby if you see the RSI below 30, you straight away buy. And if you see the RSI above 70, you straight away sell. What's the problem with that? Well, the RSI can stay above 70 or stay below 30 for a long time. And that's a lot of time for the price to move against us. Just because the RSI is above 70 and maybe the stock is overbought does not mean that the market is going to sell it. There must be a reason for strong demand for this stock. Go find out what that reason is. And just because the RSI is below 30 and it looks like the stock is oversold does not mean the market is going to buy it. There must be a strong reason why nobody wants this stock, why it's being sold off. Go find out what that reason is. Again, it goes back to demand and supply factors, which in reality is what moves the stock prices. So we don't use the technical indicators as triggers to execute trades. What then do we use it for? Well, we could use it to confirm or deny our assumptions on the particular stock. So let's say I've done my homework on this particular stock, alright, and I want to buy this share. But when I look at the RSI, I see that it's been overbought for a very long time. And the momentum might actually be slowing down. So in this case, I might want to wait for a better opportunity to buy this share. Wait until the RSI is, maybe a little bit more in the oversold territory, because I know that this particular stock is a good business. There is going to be a strong demand for this share, and therefore the market is likely to buy it up in oversold territory. Or maybe I can enter into an options position that essentially is effectively a buy in the company share. Either way, I make my decision based on the fact that this is a strong company, this is a good business, that the market is going to have a long-term demand for this particular share in the future, and therefore I use the indicator just to confirm and to time my entry. The third way we should not be using indicators is that more isn't necessarily better. Remember this chart? I've seen so many charts like this in the past, whereby there's so many indicators, they could give us mixed or even contradicting signals that could confuse us all the more. Maybe you're bullish, but the RSI is oversold and the stochastics is overbought and the parabolic SAR is neutral and the Bollinger Band is pointing down and like this is just a hypothetical situation, but like, what do you do? Which indicator are you going to follow? So let's just keep it simple. Pick one indicator that works well for you and stick with it. Remember, the indicator is just there to confirm or deny your assumptions. The main driver behind your investment decision is going to be the research, the homework that you do on the company itself, its business plan, business model, its operating environment, its profitability and growth potential. We want to use more leading factors which can give us a picture of the demand and supply for the stock, and that will help us to predict the future price movement. And by doing that, then we can use fewer lagging indicators like technical indicators that will help us to either confirm or deny our assumptions. Don't jump the gun. So there we have it, 3 wrong ways, 3 ways we should not be using technical indicators. Firstly, we should not be using them solely as an instrument to try to predict the future. We want to predict the future, we should be looking at demand and supply factors instead. These are things that drive the prices. Secondly, we should not be using technical indicators to look for trading ideas or as triggers to execute trades. Instead, we should be using them to confirm or deny the assumptions that we have made based on our study of the demand and supply factors. And last of all, don't clutter your chart with, a lot of technical indicators, because the basis of your investment decision is the study of the demand and supply factors. All you need is one technical indicator, one good one that works for you, and just use that as the instrument to confirm or deny your assumption. Alright, so that's it for this video. Like, comment, subscribe, share it with your friends if you found it to be helpful, and I will see you in the next video.